Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We are bringing the VRIC to you each and every week with our series of expert online panels. We have another fantastic one lined up for you today. We've got Wasif Latif, the co-founder and chief investment officer of Sarmaya Partners, as well as Marko Papic, author and chief strategist at BCA Research. Gentlemen, it's great to have you both on the show.
Thank you, Jesse.
Thank you so much. It's a pleasure.
So I want to start by getting both of your views on the concept of a sustained bull market for commodities up ahead. We're starting to hear the term, or have been hearing for the past few years, the term commodities supercycle get tossed around quite a bit. So from the bull's point of view, years of underinvestment in the sector, historically low valuations on the equities, strengthening supply demand fundamentals are all kind of reasons why they see a sustained bull run for commodities up ahead. On the other side, the bears on the issue will say a global recession is coming that's going to create a great deal of demand destruction. So I'm wondering how both of you see it. And Wasif, I'll start with you.
Thanks, Jesse. That's a great start off question. And we are unequivocally in the bull case, just to be clear. I had written a paper early in the summer called Return to Tangibles, which lays out our case. And it's similar to what you just talked about, years of underinvestment, a lot of policy level type of decisions that are going to go in the case of this bull market that we think has just begun. So in our view, we have started a longer term commodity super cycle. We are calling it return to tangibles for a reason. There's a little bit of a nuance and sort of a tongue-in-cheek answer there in terms of returning to something that the world had forgotten in our virtual years of the 2010s, as well as the tangible side of things, that they're physical and they're important and they're needed and they're essential for our survival and our growth as a species. So we think that that's definitely the case, and the bull market is intact. In fact, in our view, it started right at the end of the pandemic when we were coming out of the pandemic. The pandemic lows in the mid 2020 were at extremely low levels. Some would argue they were stupid levels. And because of that, our framework was developed. And I sat down and I said, well, what does the world look like going forward? And it didn't make sense to see not only that kind of pricing, but also the extrapolation of what we were seeing in terms of the transition work and the pricing reflecting that. And so our work is telling us that not only are we going to, as a market, as consumers, going to need all of the commodities that we have in the world, like energy, but there's other nuances as well, including gold and uranium, and I know we'll talk a little bit about each one of those. So oil, gas, gold, uranium, and copper are all very important part of our thesis of how this commodity super cycle will develop. Obviously, each one will have their own periods. So we're very much in favor of that. With respect to the bear case, recession is coming. That to us is a sense of timing. So when you talk to people, one of the things that we don't really discuss when we're having conversations amongst each other is, what is your time horizon? What are you thinking of with your view? And so, to put the time horizon in perspective, we think the bull market is intact because it's a strategic bull market spanning the next 5, 7, perhaps the next 12 years in our view. And as a result of that, it's a great place and a great time to be allocating to this space. With respect to the recession fears, to us, that's a near-term concern. And we think that that is something that in the longer case for the bull market is going to be intact and not a problem. Number two, the pricing of a lot of these commodities is already reflecting that. So not only the commodities have been beaten down over the past quarter or two, but the equities that are reflecting those commodity complex, like the producers, the explorers, and all of the mining companies, they're extremely cheap. And so to us, there's a little bit of a value cushion. There's a little bit of this margin of safety. If we get into a deeper, further recession, we think some of the price is already reflecting that sort of bearish view on the commodity side.
And Marko, your thoughts?
I think you can hold both views at the same time. And I think Wasif has basically alluded to that. I would be short commodities right now. Absolutely. I think the U.S. Economy is not as strong as people think. I think the soft landing narrative has become way too consensus. And all the bearish arguments over the last 18 months, which I personally had to, fight with in the trenches because I was extremely bullish on the markets and the economy for the past 2 years. As people seem to have completely forgotten about those, arguments. They weren't wrong necessarily. They were just early. So I do think that we will face a pretty significant downturn, which will be fine because the Fed does have 550 basis points to cut. So you can have a short-term view of copper, of oil, that's to the downside, while still maintaining, a sense of secular moment, of a secular space where commodities have been underinvested, and there's also a significant amount of demand pull from what I think are the two biggest geopolitical stories of this decade. One is that the West has decided that China needs to be de-risked from. And what I think is underappreciated is that China is wholeheartedly, enthusiastically embracing that policy. In other words, China is the one that's financing all the de-risking projects from itself. It's surging FDI out of China into places like Vietnam, Indonesia, Mexico in order to accommodate American national security priorities. And that requires a lot of commodities. When we talk about supply chains, onshoring, friendshoring, enemy shoring, whatever shoring you want to call it, you're building stuff, as Wasif has pointed out. It's tangibles. So that's the first. And then the second is that we all decided that climate change, will kill us by Tuesday. And that has launched another set of CapEx, CapEx intense projects around the world. So I would say that that's not going away. You can have a recession, commodities can go down over the next 6 months. If you're a trader, you should be short commodities. You're not looking beyond the curve. You don't care about that. You're just looking for weekly and monthly returns. Fine, God bless you. That can be your positioning. But if you're a longer term investor, if you're planning for retirement, or if you're running a pension fund or a sovereign wealth fund, you would then, given your sense of the moment, over the course of a decade, you would use a sell-off such as the one due to a recession to actually increase your asset allocation to commodities at those nice prices.
Real quick break here, guys. If you are a mining investor, you are without question familiar with the Golden Triangle region in British Columbia. This is one of the most prolific mining regions in the world due to its vast deposits of gold, silver, and copper. Now, for the last 4 years, Dolly, Varden Silver has been busy expanding their high-grade silver deposit in the Triangle, and they are backed by some of the smartest investors in the silver business, including the legendary Eric Sprott, Hecla Mining, US Global Investors, Fidelity, Delbrook Capital, Sprott Resource Corp, and more. If you are curious why the smartest money in the silver business is cozying up to Dolly Varden Silver, then hit the link beneath this video.
Well, let's switch to the realm of geopolitics because you touched on that, Marko, and I know that's a big area of your expertise. And how geopolitics play a role in financial markets more broadly and in commodities markets in particular. What are the main things you watch in geopolitics when you're looking at making investment decisions?
Well, obviously, if there's a dislocation in supply, that's important. Like 1 million barrels comes offline from Libya, we should probably care about that. However, I think that most investors, both retail and sophisticated institutional investors, completely sort of misuse geopolitics. For the most part, a geopolitical event has to be extraordinary for it to affect demand and supply balance in the near term. In the near term, what really matters is global growth strong? Are consumers consuming? Are tankers, sailing? That's what matters. And so notice, for example, over the last 11 months, how many commodity bulls probably were, secretly hoping that Iran-Israel tensions get out of hand. And the truth is, it didn't really matter for a number of reasons, but one of them is that the economy has not been that great, at least global economy. So demand has been relatively poor. And that poor demand has been able to accommodate any sort of risk to supply. So oil prices are actually lower than they were on October 8th after the Hamas attack on Israel. Another example of this that I have from my own personal experience, as a young investor, I remember in 2014 when Mosul fell to the Islamic State. This is May of 2014. And I remember oil prices barely budged at the time. And that was a great example. I mean, first of all, you have this like Islamic caliphate being formed and the Islamic State, packing up all their trucks and all their APCs and heading towards Baghdad and saying like, hey, Baghdad is next. And a lot of commentators were actually afraid that all of Iraq and all of its 4 million barrels a day of production could have been taken offline by these zealots. Oil didn't budge. And in fact, we all know what happened in 2014. This is, after all, a commodity podcast. I mean, it was a carnage. So geopolitics alone can't really change supply and demand dynamics. And if you go on FinTwit, if you listen to sort of the narratives out there, I was obsessed about day-to-day prices. I would fade them 9 out of 10 times. The way geopolitics affects commodities is the way I referenced in the earlier part, which is we're trying to de-risk from China. That's a geopolitical decision by the West. That is creating a persistent and secular desire for commodities, persistent and secular demand. It is a costly endeavor that our policymakers are pursuing for a number of reasons, and that endeavor is going to cost money. Similarly, geopolitics can influence commodities just by, we live in this multipolar global environment where it's very difficult to know whose side you're on. Countries are very geopolitically promiscuous. And they know that there's a volatility of supply of their commodities. So in that environment, for example, you want to have as much native resources for commodities as possible, especially for energy generation. So nuclear or alternative energy has a real geopolitical premium because for the most part, it's self-contained, it's domestic. And so I expect a pretty significant surge in uranium demand as a result of that. Also, I would say that alternative energy, although a lot of sort of commodity traders don't like it because it's inefficient, it's geopolitically very efficient. You want to try to get as much of your energy grade on alternatives. I don't care if people don't like it, if they say it's this, that, or the other. It is native, it's self-contained, it's domestic. No one's going to interrupt your supply of sun rays. No one's going to interrupt your supply of wind. And so that also is commodity intensive, at least in the short term, because you have to build out all of these facilities. And so, yeah, I think that's much more relevant. Geopolitics plays a role over the longer period of time, not as a tactical trading opportunity.
That's a very interesting view on renewables that I haven't heard before, that it actually increases energy security because you're not, there can be no disruptions to the supply aside from the vagaries of the weather. But that's a very interesting point. Wasif, how do you view geopolitics and its connection to the commodities market? What are you paying attention to the most right now?
I think in terms of timing, I would completely agree with Marko. In the near term, geopolitics makes for great headlines, makes for great Twitter posts and FinTwit, where we all get excited about all these proclamations of this is going to happen because of some event. But ultimately, in the near term, in the short term, it's all about price, supply, and demand, which is what makes the price. And so from that perspective, I would agree. I would fade the near-term geopolitical events. In the long run, however, it does have an impact because of the bigger policy environment we're in. So our view is that we are now in a multipolar world, and in the multipolar world, there are now spheres of influence. Because of those spheres of influence, there's going to be competition in building out capacity, whether it's in native renewables or in existing sort of carbon-based type of investments, or even in security-related chip investments, for that matter, or nuclear plants. So all of that is going to be doubled up. And as Marko mentioned, we've written about it multiple times, with the friendshoring and the nearshoring, all of that stuff that we need to build out in terms of capacity is going to require commodities. And so I think that's going to be, in the long term, that's going to be the bigger driver of what's happening, the bifurcation of the world in terms of the different spheres of influence. That's really going to matter. The other thing I point out is geopolitical events can have a intertwining impact based on what's happening vis-a-vis inflation. So if commodity demand is going up, then you have higher rates of inflation, which feeds into populism, which then feeds into what's going on in the policy level. So there can be sort of this cycle that gets started. Some could call it a vicious cycle. You could just call it some type of a cycle where you get into this tit for tat type of move and ever increasing in escalation to please either local populism or just continue to have this external type of need that's going to continue to push prices higher in terms of geopolitical competition that may be occurring. So we think that that's because of all of that, inflation is going to continue to be an issue. And as I said earlier, this to me is a longer term secular move. And this is coinciding with the continual drop that we saw in inflation over the years and the drop in interest rates that we saw. And we think that since 2020, 2021, we touched the lows on the interest rate cycle, which is tied to inflation. So all of this is interconnected in our view that we've now crossed the Rubicon. We're in a higher inflationary world. We're in a higher geopolitical world with rising tensions and risks, which also feeds into fiscal concerns for a lot of the developed world, where gold comes in as a big component of our views. And ultimately, it just makes for a higher inflationary and rate environment, which is conducive for commodities, as history has shown.
If I can just add two more points on a secular thesis, I think investors should kind of think about the early 2000s. You know, if you think about the early 2000s, 2001 to 2008, what drove the commodity supercycle last time was that the entire global private sector basically decided to shift production to China. That was one of the main drivers. The other was the US housing market, which, by the way, a lot of people just ignore that was going on at the same time. I think that was also important for the commodity supercycle at the time. But, you know, China, the development of China, the centralization of China was a huge part of that story. And the way to think about it, just very simplistically, is that centralization of China required a lot of copper, a lot of steel, a lot of iron ore, and a lot of excavators. So just capex. Today, we're kind of doing that in reverse. And again, I want to emphasize, China is enthusiastically embracing the de-risking from itself. I would argue that it's actually done more to accomplish American national security goals than American policymakers. It's willingly shifting production to places like Vietnam. It's building out Indonesia's nickel processing capabilities, financing all that. That requires a lot of copper, a lot of steel, a lot of iron ore, a lot of excavators. We're basically doing the same thing we did the last time we had a commodity supercycle, just in the reverse. It's that simple. And the second issue that I would also mention is that aside from de-risking from China and aside from climate change, we've also decided, just collectively as the West, that Russia is evil. You know, and that hasn't really had any impact on commodities. In fact, I shorted commodities in 2022 because I felt that the Ukraine war became too much of like a meme for commodity traders. It didn't have really an impact on supply and demand other than natural gas. But the reality is that once Russia is isolated, I do think that it will be a suboptimal outcome for Russia over the next 5 to 10 years. Doesn't have to collapse, you know, but it's a suboptimal outcome, less expertise, less technology, and that will likely lead to less output from a commodity perspective. I mean, the last time Russia was politically destabilized in the 1990s, its nickel and oil exports halved. And so at the very least, this isolation of Russia is likely going to produce an outcome where the largest commodity exporter on the planet, you know, basically peaks in its exports, in its production, at the very least. At least give me that, if you will. We may disagree on what happens to Putin and to the government, but I think at the very least, it's not going to be an optimal outcome if you're trying to run commodity production in Russia. So that's another thing to keep in mind. This is the largest commodity exporter on the planet. And effectively, the West has said it's evil. And so we shouldn't help them produce those commodities. At the same time that we're increasing the demand for commodities through our climate change policies and our de-risking from China. It's almost like the impossible trinity on currencies. We're trying to do everything at the same time. Something's going to have to break. And I think the easiest thing to break is commodity prices upwards.
Yeah, very
Can
well
I add
said.
a quick
Yeah, of course.
sorry, can I add just a quick piece of that? So Marco mentioned the 2000s. In some of the work that I've done, you go back in prior cycles and see what's been the big driver and the big theme of the market. And there's an interesting chart that I have built, which looks at the 1970s, which was oil and gold was the primary driver of everything. And because of the undercurrents we know what drove that. And in the 2000s, it was another commodity bull market based on what China did, as Marco was saying. So what if the next wave, or what if the next big commodity supercycle that we think has begun is some kind of a combination of both, where you have the aftermath of a sort of a tech boom resulting in U.S. equities coming under pressure at the higher level, whereas the commodity complex and the assets in that space, like energy companies and gold companies, do well because of this commodity growth coming out of, not China, but China-centric or China-influenced countries that are going to need that growth. And we haven't talked about India. India does have goals and plans to become a double-sized economy in the next 5 to 10 years. And that's going to require commodities as well as they build that out. Obviously, we have to fade that and make sure that over time, that's something that's going to build. And then in the 70s, you had budget issues, you had higher runaway inflation. And so, perhaps we're in the late 1990s partying like it's, the 1970s is going to happen again. So it could be like a combination of both that we see that, resulting in this next commodity super cycle.
Well, let's touch on energy specifically. Wasif, you recently released a report called Energy is Life, where you argue that the investment case for hydrocarbons along with uranium remains very strong. I'd like to get both your views on the oil and gas sector along with uranium and the potential you see there, or perhaps don't see there. I believe you're both bullish based on previous comments, but would love to hear you expand on that. Wasif, I'll start with you. Maybe you could recap what you wrote about in the Energy is Life paper.
Sure. So, that paper basically talked about how there's a couple of things. Obviously, what we talked about earlier, the underinvestment in energy space, in the commodity space is going to be needed, and that's going to be good for the companies that are in the space. So we invest in equities, just to be clear, in those sectors. And so we think the valuations, the underinvestment, is going to be really important as this continues to grow and the demand is going to be there. In the near term, yes, the recession, there is concern about a slowdown. And we've seen that obviously in oil prices, in uranium prices, they're both being reflected. There's a lot of near-term, short-term oriented traders, as Marco mentioned them. I think from a trading perspective, it makes sense to fade what's happening and think about the recession and the decrease in demand. But our view is that coming out of this, just like we did post the tech bust, if you will, in 2000 and 2001, you saw the surgence of the commodity super cycle. So we think that that's going to happen. So that's on the energy space. We think that's going to be really important. The other part to consider is the importance of uranium. So Marco mentioned the geopolitical need for uranium because people are going to want their own sort of control over what they're doing. In addition to that, uranium feeding nuclear power. So nuclear power is now again getting attention and coming back to the front as perhaps the ultimate sustainable source of energy. It's clean. It's on a relative basis. It's actually very safe. And it has the biggest bang for your buck when it comes to producing the amount of energy for what goes into it in terms of the size. And so there's a lot of attributes that are bringing nuclear power back into the front. And this movement can coincide with the AI boom and the need for AI's energy intensity, where in addition to sovereigns and in addition to governments, you could get bigger companies like technology companies actually getting into this space. We've already heard news of companies like Amazon and Microsoft getting into this space just to be able to have some power stability and power sources. So there is interest, I think, from that vantage point as well. And so to us, and we know the uranium cycle between the time it takes to mine, to get it out, to enrich it, and to actually get it into a plant and up and running. It's a multi-year cycle, and the supply with what's available is just not enough to meet the demand that's out there. There's about 440 odd change power plants in the world that are operating that need continuous uranium, but there's an equal amount, if not more, that are either being planned or in the construction phase right now. And so all of that is going to continue to need uranium as well. So right now the market is discounting that and worried about a recession, and there's some near-term trading and shorting going on with some fast money. But as investors who think about the longer term, to us, the central thesis of energy between oil and gas is extremely important, because it's going to be needed much longer than the current zeitgeist is saying we're going to be not needing it in 10, 15 years because of the energy transition. Our view is that we're going to continue to transition with the energy transition. It's just going to be much longer and further out in time as we learn and grow. And maybe this is sustainable energy 1.0, and we need 2.0 and 3.0 to really make it work. And that's not 2050. That's much further out in our view. And as a result of that, the current view of oil and gas is underappreciating that, the longer term view. Obviously, the near term and the short term view is tied to the recession fears. And so for longer term investors, as Marko pointed out, the family offices, the sovereign wealth funds, the strategic investors, this sell-off is actually an opportunity to get in and participate in that longer term jump. So that's our view on both oil and gas, as well as nuclear having that renaissance, and uranium being a key component of that.
Yeah, completely agree with you there. There's much wailing and gnashing of teeth on social media when it comes to uranium in particular. People want the thesis to work right now because they need to put a down payment on a house or something like that.
We're
Guys,
in a TikTok world. We want it now.
yeah, FinTwit is a place to go if you want to have a laugh and have some fun, but please don't go there seeking financial advice. Marko, would love to get your thoughts, and would also like a little bit of a follow-up after you talk about oil and gas and uranium, and maybe touch on renewables again, because the vast majority, I would say almost everybody I speak to in the commodities sector, aside from CEOs of battery metals companies and companies related to the green transition, are very negative on renewables, to the point of saying they're completely useless, they should be abolished and not even be part of the conversation. So you could start with that or you could finish with that, but I would love to get your thoughts there as well.
I mean, that's hilarious. I think people are way too emotional. First of all, I do take financial advice from FinTwit, so I disagree with you completely, Jesse. No, I do. I've made all my money off of idiots on FinTwit. Basically, I go on FinTwit. I see, everyone's long oil, so I short it. And it almost always works. So a couple of things I want to say. First of all, in EVs, Volvo just announced yesterday that it's not going to go fully EV by 2030. Consumers are, I think, hesitating to buy EVs for more than just the price. I think it's also quality, it's hilarious to me that everyone's like, oh, Tesla's awesome. Yeah, Tesla's also $120,000. I can buy a lot of cars that are like 80 to 120K that are awesome. I think that's the first issue. There's less and less enthusiasm for EVs. It's kind of peaking, so that will mean that the demand for oil and its derivatives could actually surprise to the upside. The second thing I would say is, on uranium, I think that the thesis there is really pretty well set up. The last uranium bull market had an 1,800% basically increase in prices from December 2000 to June 2007. So thus far, the prices since November 2016, they're up 400%. But we're still not at the level of price increases we saw in the last uranium bull market. And if you actually compare the build out in reactors in the 2000s and today is much more significant. So the build out in reactors and in the demand is much, much higher than it was in the 2000s. And the supply is actually more constrained. Now, yes, I think you will see a lot more mines come online, especially in the West, that will be sort of geopolitically sanitized. So supply in Australia, in Canada, in particular in the US. But as we know, mines take a long time to come online. So, that's the thesis here. My firm, BCA Research, we've put out a double header on this. If anybody is interested, you can reach out to us. We have a pretty high conviction view that the uranium, the secular bull market uranium is very much intact. Maybe it's only halfway through. I agree with Wasif on oil and gas. I mean, I don't really have much to add there. I would only say that the one part of the sort of fossil fuel complex that I'm pretty bearish on is LNG. I think that we've overbuilt supply. There's a lot of supply coming online, and I think that it will compete with uranium and with nuclear power. I mean, you see that actually literally happening in Japan as they restarted their nuclear power plants. Their demand for LNG has come down, and part of that has to do with prices and Europe pulling the prices higher. But I think this is one of the theses for why I'm very bullish in Europe in general. They will build out capacity to import LNG, and there is just a lot of supply coming online. Australia is done, but Qatar still has like 50 BCM coming online. Madagascar is bringing online some more stuff. Canada and then Russia actually as well is joining in on the sort of the supply. So that's the one part where I would be pretty bearish on prices. And finally, on alternatives, I just find it hilarious that there's so much anger in the commodity space. And partly because if you're bullish oil, and like Wasif said, like you put a down payment, you just inherently feel threatened by all the green alternative people running around saying this is the future. The truth is that, yeah, it is subsidized. It's, you could argue, you could do the math on anything and find that anything is inefficient. And so, yeah, a lot of subsidies went into alternatives. It costs a lot. You have to go to mines of Congo and get some cobalt and silver and so on and so on and so on. But the reality is that countries are committed to it. And you do have places like Spain where electricity goes to zero. The cost of electricity goes to zero. I mean, that's a reality. That's a fact. That's not like fake. And the fact that it was subsidized by government is the most idiotic argument against alternatives that I've ever heard. Literally every technology we've ever produced was subsidized by government at some level. So yeah, initially it was inefficient, but it's getting extremely efficient. And I do think it's going to become part of the mix. And I think that Europe in particular, for geopolitical reasons, not just for ideological kind of like green reasons, but for geopolitical reasons, it absolutely makes sense that it puts as much effort as it can in in complementing things like LNG and nuclear with some alternatives. I mean, anyone who disagrees with this is just ideologically like completely blind. And by the way, many investors are taking notice. I know a lot of very sophisticated investors who are putting data centers to take advantage of those low cost days in Spain. So there's a lot of effort to actually invest based on some of the efficiencies that have been produced by alternatives. So I absolutely think it's going to be part of the mix. And if you're a commodity trader or if you're a commodity investor, you should then look at what is going to be required to build out these alternative sources of energy, in particularly from the metals perspective, because I think obviously the demand for that will go up.
Absolutely.
I would
Great
agree.
perspective there. Yeah.
Just one quick thought, Jesse. I would agree with Marko on. I don't think alternatives are going away. What I am saying, and I think Marko is in agreement, is the timeline and the trajectory of them taking over and carbon-based, oil-based complex completely going away. That's unrealistic in time frame and the mix shift. So we can produce electricity in Europe, and that's fantastic. And they can obviously utilize that for not only their living but also production capabilities. But there's a lot of stuff around the world that moves around and needs oil between transportation, between heavy machinery, earth moving type of stuff. And as we build out the infrastructure of the world, we're going to still need that. Warfare, for the most part, to my knowledge, is still conducted on old-fashioned oil and gas, so that's still going to be needed as we get into a greater geopolitical world. And then lastly, I think the incremental growth of the global economy and the population growth is in Asia. And as that continues to happen, they're going to be playing a big part in that as well. So all that tells me is yes, renewables and alternatives are here to stay. They're not going anywhere. Number one, I think they're still in their nascency and they're very inefficient in being able to replace oil and gas. And then secondarily, the timeline is much, much further out because of that. And we need the oil and gas of today to build the green future that the Greens want in however many years that might come around.
Yeah, that's a great point. There's a lot of hydrocarbons needed to actually facilitate this alternative energy, the creation of solar panels and wind turbines, etc. Let's talk about gold and silver. Obviously, gold at nominal all-time highs recently, breaking 2,500. Silver having a very hard time breaching and staying over $30 an ounce. Again, in that situation, maybe we're talking a little bit short term. We're talking about people who get frustrated with uranium. I think there's no group of investors who get more frustrated and despondent than silver stackers in particular. The people who like to stack silver in their basement are very upset these days, by and large, if you base it on Twitter and YouTube comments. I'd love to get both your thoughts on both of the precious metals, as well as how you see the gold and silver mining sector positioned, if there's any opportunity there. And Marko, I'll start with you on this one.
Well, we probably want to defer to Wasif because he actually trades these things very actively. But yeah, I mean, miners haven't kept up with gold prices, as an example. I do think that there is an opportunity there. Gold has been my number one recommendation, aside from being bullish on equities for 2 years. I closed my bullishness in July, so I'm not really bullish on US equities anymore. I've been bullish on gold during that same period, much for the same reason that Wasif is, which is that, you know, I think that as CPI comes down, it doesn't mean the break-evens necessarily will, or that long-term inflation expectations should. So CPI and the long-term inflation expectations can diverge. They have diverged in the past. In the past, it was a head fake. So the last time we had CPI collapse at the same time that long-term inflation expectations went up, it was a huge head fake. It was 2009, 2010. That's when the gold bugs were kind of shaking their fists saying, all this QE is going to fuel inflation, because I read a tweet of Milton Friedman. And my argument was that, you know, printing money is irrelevant. Like if I give both of you $7 trillion each and you put it in your mattress, you know, did a tree actually fall in the forest? You know, like, no. And so that's what happened in 2009, 2010. But the difference between then and now is astronomical. And it's astronomical because of fiscal policy and of populist macroeconomic policies, which are actually weaponizing whatever liquidity is in the system. And so, yeah, I think that this time around, it's not a head fake. CPI can't come down. If we have a recession in the United States, CPI will absolutely come under 2%. You know, the Fed will declare victory, and then it will cut rates by 300, 350 basis points. We will have the Will Burns mistake, quote unquote, and we'll have, you know, a second wave of inflation, particularly because if you look at US politics, or really politics of any country other than Argentina, ironically, but if you look at politics of almost any country out there, I mean, what's the consensus is populist macroeconomic policies. I mean, you had a candidate in the US try to campaign on orthodoxy. Her name was Nikki Haley, and she got like 20 out of 2,500 delegates in the GOP nomination process. So as long as that's the case, I want to own gold. It's a hedge against longer term inflation. And so, yeah, I think that's still a good trade even at these levels. If politics changes, if you start seeing policymakers take seriously fiscal consolidation, then you should probably abandon that position. As for silver, I think it's more real economy story, and I think as soon as we get like a stronger economic cycle, I think silver will come back.
Great, Wasif, you wrote a paper, I believe it was Gold, Return of the King. One really cool thing about your research papers is you quote Lord of the Rings a lot in them, so I really enjoy that. Maybe break down what you wrote there and how you see gold and silver and the valuations on the miners right now. Is there some opportunity there?
Yeah, so thank you. Big Lord of the Ring fans myself, and so all of my papers, one way or the other, have some kind of quote there. And the gold paper was just, no pun intended, but gold mine in terms of like trying to throw in Lord of the Rings quotes. So when we think about gold, there's like three legs to the stool. One is the inflation story that Marko talked about between what we had in the 2010s. I remember in 2011, 2012, Wall Street was churning out inflation hedge product after inflation hedge product because everybody was worried about inflation. Well, guess what? We didn't get any inflation. We were worried about secular stagnation and things of that nature. And so what happened was all of the money that was printed stayed in the banking system, creating all this kindling for the inflation fire. But the kindling was there, we didn't have a spark. The spark came in the shape of the fiscal stimulus and the pandemic, lockdowns and the supply chain constraints and the prices jacking up. So that to us was the kindling that really exploded inflation higher and unleashed inflation after being submerged for a long time. And once that type of a thing happens with inflation, it doesn't go back immediately. It's not like that because it changes behavior, it changes people's way of thinking, expectations, and it starts in one corner of the market and the economy, and then it permeates and moves around in different parts of the economy, and it's very pernicious and it just keeps on moving around until you get a concerted effort to stamp it down, like we saw with Paul Volcker. And we haven't really seen that yet. Longer, higher for longer is there, but we think, much like Marko just said, we think that when you look at the inflation numbers based on what happened in the 1970s to now, it's pretty much lockstep following track. So there could be another policy error in the cards, which further reignites inflation, and that would be good for gold. So that's number one is inflation. Number two is the geopolitical world that we're in. As I mentioned earlier, we are now in a bifurcated world, two spheres of influence. Geopolitical tension and risks are there, and gold offers as a hedge, generally speaking, when there's geopolitical risks and tensions there. So I don't need to elaborate on that too much, but that's there. The only one really important and notable thing of that component is the active buying of central banks of gold. We know that we've seen many charts that it was a flat line on average, and then the average just jumped up in 2022, starting in March, when the world was given the message that your money is not your money if it's in dollars. We controlled it ultimately, and so that gave everybody else the signal that they need to diversify out of their gold positions and treasury positions. And so there's been this migration. So there's geopolitical stuff in there in terms of what's happening to gold. The third thing is more of a longer term secular view of the monetary system. And the world has seen many, many different monetary systems in the past, and migrating from one monetary system to another one isn't the end of the world, it's just something new. And so, since Bretton Woods, we had gold, the dollar attached to gold. So everybody, used the dollar as the primary currency, but it was backed by gold in the 1970s. We know that ended, and now we've been in a fiat world. There is the case to be made that with the growth, economic power, and military power of Asia and other parts of the world, there could be some pressures on those folks wanting a different platform or monetary system to have a common currency denominated in. And that goes back again to independence, freedom, and sort of a little bit different away from the dollar because a lot of commodities, as we know, everything is priced in dollars. And so we probably will need some type of a big shakeout or a financial crisis or financial event that might force the world at large to reevaluate where we are with the dollar as a reserve currency and end up with some type of a basket. I know you've talked about with other guests in your podcast, Jesse, with folks around, potentially in the future, some kind of a basket where gold is a part of the mix alongside other currencies, as perhaps even some digital currencies. And so even though that's a low probability event, and even if that occurs, that might be much, much further out in time, there's still that element in there that has this persistence hum, if you will, of continuing to put upward pressure on gold. The first two components that I mentioned, I think, are the key drivers of this cycle, much akin to a combination of the 70s and the 2000s. So that's going to be a big part of what we think is going to happen. With respect to the gold mining stocks, they're probably the most attractive asset class out there in terms of valuations, and because of that, on the other side of the coin, they're probably the most disliked or hated, or maybe people are ambivalent about it because they're so small. And so what we need is gold to continue to have that gradual rise. I think for general investors at large who are allocators and don't think about gold mining stocks on a daily basis because their universe is the overall global market, and to them, large cap and mega cap play a big part, and the capitalization of gold companies is really small. I think once gold crosses 3,000, and our estimates is going to go much, much higher than that eventually when this cycle is all said and done. But there could be sort of this wake up call that pushes those investors into this space, and then they start evaluating and saying, aha, gold is moving up. These companies, should be doing better as a result of that, because their ability to compound and take, financial leverage and operating leverage and deliver a better return than just the price of gold. And that's when I think those folks might behaviorally begin to come in. With respect to the finances of those companies, they've also been feeling the impact of higher inflation, higher costs of production between oil prices and machinery and labor. And so that's been eating into their margins. But as this cycle continues, we think that the higher the gold price goes, that margin component will continue to add. So up until now, it's been the bigger players who've gotten more of the interest. They've done better because their margins are good, because they're able to manage those costs. But eventually, it'll start looking and seeping into and trickling down into some of the mid cap and smaller cap mining names as well.
Well, gentlemen, this has been a fantastic conversation. Some great insights from both of you. Greatly appreciated. Before I do let you both go, Wasif, could you tell us about Sarmaya Partners, where people can find your work, the papers we discussed as well?
Sure. The best place is to come to sarmayapartners.com. It's our website. All that we do and the strategies that we manage are there, and all of the papers, including all the interesting Lord of the Rings quotes, are there.
Excellent. I'll put a link in the description below. And Marko, tell us about BCA Research, where people can find that, and if there's anywhere else you want to direct people online, feel free.
Well, first of all, I'm just disappointed, Jesse, you didn't ask us about the price of mithril, and I guess we'll have time for that for the next podcast.
That'll be part 2. That's too deep of a topic for today.
We can talk about dragons as well. Yeah.
Yeah, I just feel like the supply problems with Mines of Moria being offline for so long. I mean,
yeah, that's a good point.
I'm not sure if Dale can pick up the slack, but yeah. So one thing, BCAresearch.com is a 76-year-old research firm. We have a commodity strategy in particular, but a lot of the other strategists at the firm will obviously talk about commodities as well. And you can also find me on Twitter at geo_Papic. So that's my handle. I do talk about commodities quite often on FinTwit, just because I find that so many commodity bulls on FinTwit are often just myopic, so I do like to gaslight them quite often, even though I'm clearly on the structural commodity supercycle side, also one of them. But yeah, bcaresearch.com is the easiest way to find out more about the firm.
Great. I'll put links to that and your Twitter in the description. Wasif, are you on Twitter as well?
Yes, I am. My handle is Sarmaya Kar. That's Sarmaya KAR 24.
Great. I'll put that
And
link in
so
the
I'm
description
active
so
there as
people.
well, and I'm posting all the time. So yeah.
Okay, awesome. Link will be below. Thank you once again, gentlemen, for coming on the show. It was a blast.